Of Econoday Unplugged. It's Wednesday, the 23rd of September 2020. As ever, Mark Pender is across the pond stateside, and I'm Jeremy Hawkins in London. Earlier this week, the number of COVID-19 cases around the world moved above the 31 million mark, underpinning already rising investor concerns that global economy is about to take a fresh hit from a second virus wave. And that with GDP in many countries still not within sight of their pre-pandemic levels, and in a lot of cases, growth having slowed significantly in the last month or so. That's prompted a pullback in the broader equity markets, but it's been to the benefit of government bonds, while on the currency markets, safe haven buying has also boosted the dollar to, well, at least 2 months highs against the likes of the euro. So, Mark, it's certainly not good news on the coronavirus. Obviously, we just had some flash PMI data, which everyone looks at, the latest insight into how the economy is going. What's it look like from your side?
Well, we just got them right now, and this is Wednesday morning here in the U.S. We got these are 54.6 for services and 55.3 for manufacturing. These are both over 50. They're actually kind of ideal rates. If this was in the middle of a stable situation,
thank you very much. Yes.
These would be, marvelously sustainable, predictable, very, very, over a long period of time. These would be very strong rates of monthly growth. But, we're dealing with.
Is it well spread? I mean, is it like current output and new orders? And what's the orders side doing?
It looks pretty good, and it's also balanced between manufacturing and services. So that's the first balance, and both samples, details are limited in what market economic provides to the general public, but the descriptions of new orders are solid growth there. Both backlogs appear to be building in both groups, though at a slowing rate. Employment is also kind of it typically or often is in line with backlogs. So, but apparently it too has been slowing. So there's not a lot of employment growth, but the orders look good, and production and output looks good, and the price data shows pressure for both inputs and selling prices. And so it's like an ideal looking, in a normal situation, this would be exactly what you want. Not overheating, not too cool, everything, steady Freddy, but it's not. And so I think it probably is a deceptive. Now, the ISM's service and manufacturing samples, and they're a different group, a longer standing group that's been doing it, have been showing greater rates of growth than the market samples. So really, market is kind of just caught up with the ISM samples. But it does suggest that there is optimism in these samples. I mean, it's not bubbling with optimism, and there is caution given COVID and also the election, and and also the unemployment here in the U.S. Still more than 10 million people are unemployed, and or greater than what it was before the virus. So that's a lot of people. That's a lot of demand that has disappeared, and with COVID issues reappearing in Europe, that's one trading partner that may not be accelerating their purchases. So it's hard to tell. Now, for an optimist, you can grab a hold of this and go. But I think probably a cautious, more realistic view would be an order which would suggest that even though it looks stable right now, and it's been stable for the last several months in this report, it could be a bumpy time ahead. So now let me turn this to you, because what we saw in Europe, which released their PMIs earlier, was especially outstanding in Germany, was this separation between manufacturing and services. Manufacturing, they're doing very well, at least in this 1 month, and services not doing well at all.
Yeah, that's right. I must say, just in terms of the broader picture, I think there'll be a number of European policymakers looking across to your side, thinking that the eurozone, wishing rather, I should say, that the eurozone economy is performing half as well. As you mentioned, as kick-offers of the headline figures, I mean the Flash Composite Output Index, so the GDP proxy, if you like, for the eurozone in September was just 50.1. So to all intents and purposes, the economy was just stagnating. Now, that was down from 51.9, the final reading in August, which in itself only suggested a very sluggish rate of growth from what's been an exceptionally weak base. So the general overall picture of the Eurozone economy just in itself is kind of worrying, I think, as far as the policymakers are concerned at the moment. But also, as you mentioned, we do have a very marked division between what's going on in manufacturing and in services. As you mentioned, for Germany, it was particularly marked. We had a manufacturing index of up at 56.6, which is a particularly strong number, a multi-year high, in fact, as far as Germany is concerned. And that contrasted with services moving back into negative growth territory at 49.1. And that was reflected in the overall Eurozone picture as well. So manufacturing there was up at 53.7, which, as you were saying, equivalent almost from your side, if that was a number in more normal times for the Eurozone, that would actually constitute a pretty good reading. But that 53.7 can contrast very sharply with 47.6 on services. Now, that's a 4-month trough and really suggests that, services have perhaps peaked already. And possibly it's the case that the COVID restrictions we got in place at the moment, and which indeed will be increasingly in place as they bring in new measures over coming months, it could mean that that's already putting some kind of lid on demand for the service sector output. If that is the case, then that's going to be a real problem, because it's going to mean that the Eurozone economy is close to topping out when it's still the best part of 10% or so, I suspect, below where it was before the pandemic itself actually hit. So numbers here worrying. And I suppose if we go back to the first wave, one of the patterns we saw there was, the big hit right across the economy, but we did see services being hit significantly harder than manufacturing, particularly in the opening months. And I think just the nature of what we've seen in the September data, that's going to agitate worries that, perhaps this is the same sort of thing happening now. So it's so far not so good, I think, as far as Europe's concerned. And I think from the way the economy is performing, even prior to today's numbers, there's been some hints coming out, certainly from the likes of the ECB, to the effect that, this economy is going to need more help from some shape or form. Christine Lagarde, the ECB president, last week was kind of intimating that there's still a lot of problems. The COVID situation remains very uncertain. What are we going to do? And there's more room to increase quantitative easing or do something with quantitative easing if necessary. And indeed, there was an article, I think, in the Financial Times beginning of this week, which was suggesting that the ECB was already undertaking a wholesale review of its pandemic emergency purchase program. Now, that's subsequently been denied by the ECB, but on the grounds there's probably no smoke without fire. I think markets now are starting to contemplate the idea that we could see an additional easing of policy coming out of the ECB at their next meeting on October the 29th, or if not, then perhaps at the December the 10th one, when they'll be updating their economic forecasts. But it's it's not a particularly good picture as far as Europe's concerned at the moment.
Well, let me just add that the Japanese PMI came out, and they're the weakest of all. 47.3 for manufacturing, and it hasn't been showing any life there, and services at 45.6. So they're seeing quite a significant COVID effect, and that's not very good for the U.S. because the Japanese and Europeans are big partners, and
yeah, sure.
And if they're Japanese have never really come, their PMIs, and they've been among their data in general have been pretty soft through tailing during the COVID crisis here. Excuse me, but I just wanted to throw that in. Let me pass it back.
No, it's interesting because we had the BOJ meeting the other day, and they kept policy on hold. But they actually upgraded their domestic growth forecast. So it's going to be interesting to see whether or not they end up having to take it back again in the light of the way these PMI numbers are coming in.
Yeah.
In terms of policy, I want to ask you about fiscal, because last week just touched on what's going on in Europe. I suppose just quickly a very quick update on that one. Of course, the ECB is looking across the European Commission about how's this recovery and resilience facility, as they call it, getting on. This is the 670 billion euro package, which is part of the EU's so-called next generation plan, this 750 billion package. Well, as things currently stand, EU announced last week that member states would need to submit their recovery and resilience plans. Though this is for those countries which want to receive some funds, they actually have to say why they want them. Now, the deadline for that is actually as late as the 30th of April 2021. So it looks as if this thing is going to be a long way coming through.
But Jeremy, that doesn't make any sense. This is emergency stimulus, right?
It's supposed to be emergency stimulus, but they actually, at the moment, the EU Commission said, it is last week, that it wants the package in place by January the 1st of 2021. So they're not expecting it to be passed through the European Parliament and all the national individual parliaments until we get to the back end of this year. So although it is the case, in theory, it's kind of been agreed, obviously subject to some of the Hungary problems we talked about last week, in terms of its actual delivery, making a blooming difference to the Eurozone real economy, this month's away. Hence, we're back to the poor old ECB again, which made me wonder. There's been all this, this fiscal policy package touted your side of the water. Where do we stand on that? And I suppose your numbers perhaps aren't increasing the pressure for fiscal pressure.
No, well, that's right. Well, where we stand is up in the air. But you're exactly right.
Good answer.
But you're exactly right. The data that's aside from employment, much of the data that we've been seeing, and really aside from the production, industrial production side of the economy, things are looking pretty good, or things are improving, along with the infection rates are stable. So lockdowns here are limited. So there would be every reason to think that, and like we were saying, beginning with the PMIs, every reason to think that this recovery is, standing on its own and is able to move forward. But as far as so the pressure for fiscal stimulus is limited. Also, this morning we had the FHFA house price index, and that in 30 years of data, they've never seen a strong price growth as they did in June and July. So the housing market, and before that we're getting new home sales tomorrow, which are expected to push even further beyond their pre-virus level. We had existing home sales yesterday, which did press further beyond. The housing market here is on fire. And so that's another reason.
And is that generally, or is it in certain parts of the country?
The greatest, there's a definite spread in housing demand in the U.S. It's the greatest demand tends to be out west. It's a smaller market in general, so it has a lower established base of housing, so you get bigger percentage movements over there. You get general weakness in the Midwest, central and upper Midwest, also in the mid-Atlantic states, Philadelphia, Pennsylvania, Maryland, those areas. And although Maryland can be a very good market, but so there is regional differences, but on net, but those are generally stable through the years, and so, but on net, what we're seeing here is across the board huge lift in housing demand that belies or reveals the details of the unemployment situation here, that it's centered in the lower wage group and not the upper wage group, and that this group is enjoying high stock price values, continuing to enjoy generous employment with low interest rates, you're seeing, and this COVID effect, you're seeing this huge move into U.S. housing. So that's another factor that pushes the urgency for fiscal policy away. Excuse me. But as far as what's going to happen, it looks to be an abeyance here until the election. And then after that, we'll see what happens as on the fiscal side. The Fed is already in trying to do all it can. There's nothing else it can do right now. And so I think we're just going to have to sit tight and see, how the election plays out. And then what kind of government, if it's a unified government or if it's if there's a conflict government contention, then that would limit the amount of fiscal possibilities. But it's too early to say here. I don't think there's going to be any developments until the election.
Okay, fair enough. Yeah, housing market wise, I suppose Europe's a bit harder to sort of ascertain the quarterly housing price figures out of the Eurozone, at least on a quarterly basis. We don't have second quarter data as of yet, so it's really difficult to say what's going on there. Looking at the borrowing for house purchase figures, they've been running pretty flat on a annual growth rate at around about 3% or so in recent months. So it looks as if it's still chugging along, but certainly nothing like the kind of strength we see on your side. But it's got to be said, the UK housing market is doing well. House prices over here have more than recovered their pre-pandemic levels. Indeed, they're running at record highs now. And of course, the UK housing market, there's a lot of homeowners in the UK, and so it's a particularly important part of how the UK economy performs. And the government's been doing its best to keep that going. So he introduced a temporary increase in the stamp duty land tax threshold. That was from £125,000 to £500,000 a few months ago now, and that certainly seems to have helped to underpin demand. So we've seen a pretty strong housing market in the UK as well. And that's probably just as well, because I mean, just going back to this COVID issue, I think things across Europe at the moment are looking pretty grim as far as the overall European picture stands.
Well, they're coming out with the word second wave. Did I see Boris Johnson using that word, or who did I see using the word second wave?
Yeah, he was talking in the House of Commons yesterday when he was announcing a new set of measures, and it's not just him either. Effectively, the World Health Organization is talking the same thing, as is the European Centre for Prevention of Disease. So we currently, as we record this, I mean, European new cases now as Europe as a whole have exceeded those reported during the peak of the pandemic back in April, May time. So there was a sharp decline in cases in subsequent months until over the last 4 to 5 weeks we've seen this very rapid pickup. There's been huge numbers coming out of the likes of France and Spain in particular. And so we are at this stage now whereby there's a whole raft of new measures being introduced by different countries. Now, at this stage, no individual country wants to reinitiate any kind of a complete blanket lockdown. That did so much damage to the economies in the first wave. They really don't want to have to do it again. It would be a last resort. Nonetheless, we are seeing bits and pieces of restrictions being introduced. Say for the UK yesterday, things like the pubs and restaurants will have to close at 10 o'clock. There'll be a curfew on them then, and some other bits and pieces of package which ultimately will translate into some kind of loss of economic growth. So what we're seeing at the moment, I think does suggest that the European outlook is that much worse now than it was, let's say, a month or so ago. And I guess that's one reason why we've certainly seen a bit of a pullback in the euro. Not so long ago, euro dollar was trading up around the 120 mark. Well, as we speak, it's 1.167. So it does appear to be the case that investors reacting to some of the bad news coming out of Europe on that particular front.
Well, I'd like to go back to some of the good news, and that was that German Manufacturing Pmi. Now, I know that they don't give very many details in that report, but what's your hunch? Where was their strength? Where would that appear? Would it be in autos? I mean,
I think we obviously, as you say, we don't get the details on that yet. We'll get more of it when we actually get the official orders data coming through from the Federal Stats Office, but that's a while away yet. But yes, already we have seen a very sharp recovery in the auto sector, which is the key area of German manufacturing. So I suspect it means that we've seen continued strong growth coming for German auto producers during the course of September. Now, whether or not that's going to continue, We don't know. I mean, from the breakdown of the orders data we've had in earlier months, it looks as if there's been, some increase in domestic demand. If anything, though, a stronger gain in overseas demand. But if we're going to start to see these COVID numbers rising generally, then, well, it remains to be seen whether or not that's going to be the case. But yes, as things currently stand, German manufacturers are actually in quite good shape at the moment. And indeed, there was a report from the German Retailers Association, was it yesterday or the day before, intimating that they think German household consumption is going to be a good deal stronger over the second half of this year than they originally expected as well. And I suppose at the end of the day, it comes down to, well, why is that? Well, COVID cases in Germany compared to the rest of Europe are still pretty low. There does appear to be faith in Angela Merkel's government and way it's, the testing and tracing and the various restrictions they put in, how they've been handled. And so far it appears that Germany's going to be one of the best performers on that front. So, and that's ultimately, of course, will be good news for the rest of the Eurozone, because Germany obviously dominates aggregate demand there.
Let's turn to Switzerland. Now they have a policy meeting tomorrow. Now, aside, and just as a segue to go into the bank issue, is aside from finance, what is their strength? What is their economic strength?
Well, obviously, it's the financial sector which dominates the Swiss economy. So where that goes, pretty well Switzerland goes as well. Otherwise, I suppose their main interest is going to be in the chemicals industry and things like clocks and watches, where they export a massive amount as well. But it's really the financial side of things which I guess Switzerland tends to be one of the world leaders in. With regards, though, to Swiss National Bank, as you mentioned, we will get this meeting tomorrow. Expectations there really for no change in policy, which I guess in some ways could be slightly misleading. And really, it's, as we talked about on previous podcasts, so much of this comes down to what's happening with the Swiss franc and particularly the euro Swiss franc exchange rate. Since their last meeting in June, we've actually seen the Swiss franc lose ground against the euro. It's lost what, about a couple of percentage points, something
which
like.
Is for the SNB, that's good.
Which for the SNB, that is very good. The big problem for the SNB, well, obviously what's going on in the real economy, but they've been stuck with a negative inflation rate for months now. They try to keep inflation close to the 2% mark. And although, okay, we know it's kind of COVID and the real economy, perhaps it matters more at the moment, but they've been struggling to, really prevent a deflationary environment in Switzerland. And so long as we've got a very strong Swiss franc, and we're talking as we speak, where are we? We're about just on just around about 107 euro Swiss franc at the moment, so 1.07 francs. Well, the Swiss authorities used to have a lower floor. So this is Swiss francs per euro. They used to have a lower floor back at a few years ago at 1.20. So effectively, this currency has been trading 10% plus below that level, i.e. on the strong side against the euro for the last several years now. And that's certainly been reflected in this constant downward pressure on Swiss import prices. It's led to inflation being either very close to zero or for the last several months now, below zero, and no sign of it increasing again.
So if I remember the numbers, the Swiss CPI is a little bit in the negative range, or a bit in the negative range, as opposed to everyone else who's basically around flat or a little bit above it. Is that right? General characterization?
Yeah, that's pretty well right. I mean,
and that difference we can attribute to the strength of the Swiss franc?
In many ways, well, certainly part of that, I think we most definitely can do, because it's not just the case that we've seen the odd blip up in the Swiss franc. It's been running at what the SNB called highly valued rates for some considerable time now. I mean, headline inflation in Switzerland, let me think, as of August it was zero. Prior to that is minus 0.2%. So it's been zero to a small negative number for a long while now. But if we look at the breakdown of this, the domestic component of consumer prices in Switzerland are actually slightly positive. The problem is, though, that the import component of the CPI is running at about minus 3% or so. So this is what's dragging down the overall CPI. So in other words, it's really very much a reflection of Swiss franc strength pushing down, reducing import prices, which then duly help to depress the overall level of consumer prices. Now, that has meant that for some considerable while now, as we as mentioned, the Swiss National Bank's policy has been tied to what's happening to the Swiss franc. The fact that the Swiss franc is a little bit weaker against the euro than it was back in the June meeting when they didn't do anything, it doesn't guarantee, but strongly suggests that they won't be doing it this time round either. However, that said, although there's been no change in interest rates for a long while now, their so-called policy rate stands at minus 0.75%. So it is it's one of the most negative central bank policy rates anywhere, simply because of the currency issues. But what they have been doing quite steadily is intervening behind the scenes. So even though we've got, say, this weaker Swiss franc, the sight deposit figures at the Swiss National Bank suggest that the SNB has been really intervening quite steadily over pretty well since beginning of July time, right through into the latest weeks. So they're operating in the background, trying to prevent the Swiss franc from appreciating any further. Were we to see, let's say, a really big burst of COVID, which translates into this mass panic and buying of safe haven instruments, obviously the dollar would do well there, but within Europe would almost certainly see a move back into the Swiss franc again. And that's when the question is, what would they do? Would they actually take interest rates down even further? They don't want to. They certainly don't want to do that, but they might have to. So I think at this stage, policy tomorrow looks most likely to be left on hold, but the risks at this stage remain very much it will have to come out and ease yet further.
We were talking recently about foreign exchange policy in central banks and how it is not a part of actually the last press conference. I guess it was last week. There was not a single question. It was an hour long, and not a single. And in the policy statement, you could not find the word dollar. So
it's interesting because that is increasingly the opposite to over here now.
Well, and I want to go to New Zealand Reserve Bank had a statement today, and it mentioned the possibility of buying foreign assets, and presumably that would help limit the appreciation of the New Zealand currency. But crossing, I can understand why the Fed wouldn't want to cross that line. It would just mean one more thing. They'd end up having to manipulate the dollar all the time. But I guess the Swiss, and is that how you read did you read the New Zealand Reserve Bank of New Zealand statement?
I did. I mean, I think it's interesting. You say they came out earlier on. They didn't actually change their overall policy in the stance in the sense that the official cash rate stays at 0.25%, and the large scale asset program that was still held at 100 billion New Zealand dollars. But they did also come out and say that they're making significant progress looking at additional instruments, which might include a sort of funding for lending program. So basically lending to the banks on the condition that they on-lend into the real economy. And that's something which the Bank of England and the Treasury over here have been using quite effectively for some considerable while now. And they may be looking at other instruments, notably including possibly, a negative OCR. And there's been now some speculation that the official cash rate might actually go below zero at the beginning of next year. And part and parcel of that, yes, I mean, the problem for the likes of the commodity-based currencies is that they do get swung about a lot by what's happening to commodity prices, and they've been concerned, I think, by the rise of the New Zealand dollar over the course of the last few months. However, again, we go back to the COVID situation, though. If we see a hit to global growth due to COVID, and we get the repeat of what happened back in March and April, then commodity prices go down, oil prices in particular go down, and those commodity-linked currencies will come under pressure. And part and parcel of that, would be the New Zealand dollar, alongside the likes of, Mexican peso and the Canadian dollar and the Norwegian kroner and currencies like that. But yeah, it's interesting on this currency side because Christine Lagarde, for the second time in a week, mention the euro in the context of it being an important factor in setting monetary policy. Now they're always going to come out and say, of course, we don't target the euro, but I think what she's trying to do is sell a message to the market, whereby, well, look, if this euro continues to be strong, and as she points out, is putting downward pressure on imported inflation into the eurozone, which is not what they want with inflation so low. I mean, it's already below zero at the moment. Then it could ultimately mean that the strong currencies, although they're not going to intervene against it. It could be one of those factors which, is part of the jigsaw which causes them to come out and increase quantitative easing. So currency issues at the moment, I think, are very much an issue to the front in Europe, simply because you've got such weak growth. You don't want anything which is going to dampen it. And obviously, the stronger is your currency, the less competitive you are. So it's going to be interesting on that front. Okay, as usual, we've probably been talking for far too long. Is there anything else we should mention?
Well, what's it like at the COVID increase in the UK? Is it a big concern? I mean, the press over here.
It is. I mean, I think the statement made by the Prime Minister yesterday, well, I say the statement by the Prime Minister, I think the numbers over here have been surprising. I mean, they've taken off quite dramatically over the course of the last couple of weeks or so. And for the Prime Minister to come out and announce, a new set of restrictions, which, to be honest, could have been a lot tighter, because effectively intimated they're going to be with us into the beginning of next year.
Is it a reason? I mean, did they reopen the schools? Was it the parks staying open too late?
It's part and parcel of the same thing. I think, yes, it is. Basically, it's just a reflection of the fact that the UK economy has been steadily reopening. The schools have all gone back. The pubs and the bars and all these have reopened, albeit with social distancing. And it's got to be said, some of this social distancing has been blatantly flouted by parts of the population. It doesn't take much of that to cause it to spread again. But I think, the bad news over here is that what's been announced so far is actually quite lightweight. If we compare to what Scotland have just introduced, they've introduced much tighter regulations. They set their own by the Scottish Parliament up there. And I think what they've done is probably going to be a precursor to what we're going to have to do over here, which is not a complete lockdown, but moving back towards a sort of a lockdown environment.
I saw Wales was up too with lockdowns.
Yeah, that's right. I mean, really, England is currently sort of lagging behind what the smaller parts of Great Britain are doing at the moment. So I think there's a real risk that we will go down the same route. And if that is to be the case, yes, it's got to increase the likelihood of additional, policy reactions, easing through perhaps a negative interest rate, or the bank doesn't seem keen on that at the moment, but almost certainly additional quantitative easing. And indeed, as we talked about on previous podcasts, that the furlough program over here, which is supposed to be ending at the end of October. There's so much pressure on the Chancellor now to try and extend it. It seems extremely likely it will be terminated completely. There'll be at least some form of targeted furloughing, or some kind of new scheme which will have to replace it. Otherwise, unemployment here is going to go through the roof. So difficult times, and not particularly great ones at the moment. So I'll give you the last say. Anything else you want to chip in before we round this off?
Well, just take it easy and wear your mask. So
indeed, it's true. I mean, the sad state of affairs, you're starting to get used to it now. We all look like bank robbers over here. Okay, then let's round it off for this week. I suppose you've got to say, with the virus on the rise again, policymakers really do face an unenviable task of balancing the need to keep the economic recovery going while at the same time not adding to the risks of public safety, all of which makes for a potentially very volatile outlook for financial markets. So even more reason then to keep up to date with all the key market moving data and events in Econoday's global economic calendar. On behalf of Mark and myself, thanks as ever for listening. Stay safe, and we'll see you next time. Bye for now.